This is the time that we have one of the most interesting set of constraints that policymakers have that I've ever seen. They have to lower the dollar valuation, they have to cut rates. There's no way around it. There are two things that are really underappreciated. One of them is credit spreads. Now, I suspect that we're getting to a point where credit may actually start deteriorating quite significantly. When you have spreads as high as they have been recently, that's not usual, that's not normal. It's almost like the calm before the storm. I mean, I can see a world where two-year yields at 4% today could be cut in half. The dollar is at a dangerous position in a certain way, and I believe it's inevitable that we are at a turning point in history, that the dollar could see a long-term decline. $3,000 gold, and you have international banks buying as much as they have been, and the US being pressured to do the same, probably translates into a lot of, higher prices in gold. So
we might have the perfect storm for super cycle in the commodities in the next 10 years.
I'm going to just say one other metal that I'm extremely bullish on, that I think is extremely asymmetric.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexei Duranov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the emergence of a new monetary system with some money like gold, silver, and digital assets like Bitcoin. We'll also investigate how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Today, I have the pleasure to welcome again on the show Tavi Costa, who's a Brazilian-born macro strategist and portfolio manager at Crescat Capital, a global macro asset management firm based in Denver, Colorado. Known for his data-driven insights, Tavi specializes in identifying long-term investment trends across global markets with a particular focus on precious metals, emerging markets, and monetary policy. He's widely respected for his bearish stance on fiat currency debasement and his bullish outlook on gold, silver, and commodity-driven investments. Through his charts that you've all seen online, research, and active presence on social media and financial panels, Tavi has become a prominent voice in the macro and contrarian investing community. It's a pleasure to have you back, Tavi.
Pleasure to be here. Looking forward to this conversation.
Let me first start by asking you, what is the most underrated or underappreciated risk you see in the markets at the moment?
Probably two things maybe, and they're probably related. I think that we're in the process of seeing the rebalancing out of U.S. equities into other things. There's what I call the domestic imbalance and an international imbalance. The international imbalance is the fact that there's so much capital in the U.S. versus other countries. That might be one rebalancing. And the second one is how much is in tech, specifically in the large cap companies versus other parts of the market in the US. And that's also switching. So to go back to your question, if we see those things turning, which I believe that's sort of the macro landscape, then there's two things that are really underappreciated in my view. One of them is credit spreads. Now, I suspect that we're getting to a point where credit may actually start deteriorating quite significantly. There are signs of that. If you look at leverage loans, it's a great way to look at it. They've been breaking down recently. And if you look at junk bonds, they're still, very overvalued in general in our view. And also, if you look at that relative to Treasury yields, clearly we have, what I think it's an opportunity to see credit spreads really widening substantially. For those who don't know, credit spreads is just a way of betting on markets actually having significant issues, and so it's usually this is sort of something when you have spreads as high as they have been recently. That's not usual. That's not normal, and what we tend to see is a period of very high volatility coming out of those. It's almost like the calm before the storm kind of type of research, but that actually happens many times throughout history. And so this is one of them that I'm really focused on. And then the second one is the 2-year yield. I mean, I can see a world where 2-year yields at 4% today could be cut in half. And that's a huge call. I don't think anybody else is appreciating the fact that we could see a recession. Let's just say a recession is a 50%, 60% chance. There's no way 2-year yields should be where they are. And so I've hold the view that 2-year yields is probably it's in the process of rolling over. And I think it could be cut in half even in 12 months from now. So I'm extremely focused on those two things right now, as I think they're very underappreciated risks in markets right now.
Talking about the treasuries, you've just mentioned the 2-year. What is your feeling or your takeaway about the rest of the bond market and specifically US treasuries at the moment?
I think the whole curve could fall, but usually you see steepening of the yield curve, but it's mostly caused because the two-year yield really collapses. And this is sort of a different view from a lot of people. I think it's going to confuse some if I mention this, but I just think the Fed is going to be very stubborn. I think the Fed is not going to cut rates as initially. I mean, it eventually will, and things can turn really bad. But the initial reaction in the market would be very negative, and it would be a reaction of a recession being priced in the curve because rates are too high. And the 2-year will fall because of that, in my opinion. Now, a lot of people will think of it as like, well, wait, if you're saying that the Fed is not going to cut rates, why would you bet against the 2-year yield? It's because the market is way too smart and is going to think, well, hold on a second. If they don't cut rates 6 months from now, in 2 years, they're going to have to cut drastically. And so the 2-year yield is the one that is, really at risk right now. And the main, guys like Druckenmiller and all these big macro traders we've seen in the past, most of their money they made was in their career, as they said it before, was really on betting on 2-year yields falling prior to turmoil. And I think that's a classic sort of setup that we have today to do exactly the same. So I'm less, I have less conviction on the other sides of the curve. But look, Scott Bessent and the entire administration is focused on one thing, is bringing the entire curve lower. And, if you hear Steve Moran's recent interview as well with Bloomberg, he mentioned something that is very relevant, which is, they want to fix the problem of having chronic current account deficits. And I don't know how you fix that with a strong dollar. I mean, I don't think that's going to be the case either. So the dollar is starting to fall, but I think it has long ways to go, given the fact that it's one of the most overvalued levels in history, and that sets up some really interesting opportunities in markets. That when you have this combination of lower yields and lower dollar, a lot of things become it sort of sets up the stage for something really interesting for emerging markets, for commodities, for hard assets, and so this is why I think all these things are linked in a certain way.
We'll talk exactly about that, specifically the commodity part, a bit later in the interview. But first, I would like to dig deeper or unpack what your stance is on the economy, particularly speaking, because you just said that you think that might also shock or raise some eyebrows for others, that the Fed will not cut rates, that they will keep those rates high. But that also then entails or means, I guess, that the Fed thinks that the economy is stronger than what it actually is feared about, that the fact that there are cracks in it, that the economy cannot withstand those higher rates for longer. What is your take on that?
I think it's just because it's less about the economy, more about inflation, actually, because the Fed will take that, and also because the Fed is very political. I think it's understated the fact that the Fed is extremely political, and given the situation with Trump and Jay Powell, it wouldn't shock me at all if Jay Powell, tries to play this stubborn card that could actually, become a little problematic. I mean, look, they can do a few things, right? They can just cooperate with the Treasury Secretary and the Treasury Council in general, and basically lower rates and help the administration to achieve what they're trying to achieve, which is basically lowering the interest payments, and therefore by doing that with the interest rates, it also reduces the deficit, which is the main part of it. I mean, everyone talking about Doge and all these things, it's kind of meaningless. Really focus on interest rates, because that's really where most of the government spending cuts are going to come from. And so, yeah, I think that the Fed, if you look at the data that's been coming out, if you look at inflation expectations, if you look at the CPI, if you look at PCE, if you look at core version of those two, if you look at super core index, which is what the Fed created, which is kind of ludicrous. But again, it's not that I think those things are relevant for learning about the real inflation in the system, but they're relevant for policy making. And so when you look at those measurements today and you just apply the Taylor rule, which is, very unbiased, and, it's a model that you just throw the numbers there. So, and please, and ask the model to suggest you where we should rates be. And the model is right now actually suggesting that we should be actually entering a rate hike environment. So imagine that. Like, I don't think the Fed will do that either, but look, there's quite a few cuts already priced in the markets, and the Fed could easily say, hey, we're just going to wait and see, which is kind of what they said in the market rally on this. And so don't think the market is taking this serious. And what I think we may see is the Fed just taking a stubborn, stance and saying, I don't think we've got enough progress on inflation. So, maybe all we need is inertia, right? That they said, and maybe just, let things kind of roll for a bit and leave rates where they are, and then see where it takes us. And so I can definitely see the Fed taking that stance. And I think 2-year yields will collapse on that front, because it, if the market is starting to show issues, and the credit market is starting to deteriorate, which it is, then you need to cut rates. And the Fed and the government is cutting spending, right? If you think about what's been the most important engine of U.S. economic growth, government spending. And we've been spending easily 8% a year on fiscal relative to GDP, and I don't think we can afford that anymore. And so if you're going to be cutting, if you're going to do austerity, you need to lower rates to basically compensate for the fact that you're also hurting the economy by lowering government spending. Then you throw it on top of everything, tariffs, which I think it's less relevant than everybody thinks, because it's small. When you think about the actual impact, it's quite small. It's not that high. What is big, though, is immigration. Immigration is key. I mean, when you're reducing your population, I don't care how you do it. Is that killing people? Is that taking people out, deporting them? And not a political view at all. It's just looking at simply on the impact of the economy, or taking consumers out of the economy. It is negative. That's the bottom line. It's not positive. It's negative. And so the Fed should be cutting rates just on that front. And the Fed should be looking at these policies and saying, well, this is going to have an impact 6-12 months from now in the economy, and we should be cutting rates. And they're not. And they have reasons maybe to justify why they shouldn't. Now they're going to come out and say, well, CPI is too high, PCE is too high, supercore is too high. Look at University of Michigan, inflation expectations too high. But, honestly, I don't think the Fed has much of an option. This is why I love hard assets, is because the Fed has to cut rates for many reasons. Policymakers in general have to cut rates, And inflation is actually not fixed. Inflation is here. And so what does that do? You got that supercharged environment where rates need to be suppressed, inflation needs to run hotter. How is that going to be negative for silver? Or how is that going to be negative for copper? How is that negative for oil? You know, I did not mention gold because everybody knows that's positive for gold and that's what gold's doing. But there's a lot of other things, go to the whole periodic table. There's a lot of other things that should be going up as well in the back of that environment that I'm referring to. So, yeah, there's going to be ups and downs and changing policies. Commodities will fall and rise, but no, take a 5 to 10 years stance on this, and this is the time that we have one of the most interesting set of constraints that policymakers have that I've ever seen. They have to lower the dollar valuation. They have to cut rates. There's no way around it. And so, does inflation matter? Yeah, they have to let inflation run hotter. Why? Because we have too much debt. There's no way around it either. So, this combination of things is what you need for, and then you look at the other side and people are all bearish on mining stocks and junior miners and silver miners that will never make money. And I'm just like, oh, wow. I mean, or emerging markets. Nobody wants to invest in emerging markets today. So I don't know. There's a lot of things that are hidden opportunities, if you will, that, are all linked to what the Fed has to do here. So it's really interesting.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, security saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults, with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth. Talking about the inflation in particular, you've shared this famous chart that I've also used a couple of times, referred to a couple of times as well, where you can see the evolution of inflation in the last, I think, almost 100 years. And where we see, especially compared to, let's say, the 70s, there's 3 phases of inflation that you pinpoint. And would you say that we are in the second wave of inflation that is comparable to the 70s? Or how would you describe that?
Yeah, I think we are potentially there. I'm a little I think the shock to the economy is the bigger issue right now, but inflation is gonna come roaring back in my view. So I don't know. It's like these models don't work precisely the same, and inflation does work through waves. But it could take a little longer to see that other next spike here. And it's going to be very policy dependent. Trump wants to take a hard stance on tariffs and all these things. Yeah, the economy is going to have issues, and and you may have sort of a deflationary shock. I'm not saying we're going to see deflation, but we're going to see a deflationary shock to the markets. So it's going to be a very risk-off environment. That could happen. So I'm very open-minded to that. I don't want to make a strong call on inflation necessarily like 6 months from now, because I can see the other side of it. I mean, you can be in an environment where, it's very policy dependent, short term right now. If the let's say the Fed plays ball and cuts rates, then yeah, I'm on the inflation camp tomorrow. It's going to be Banana Republic environment. Then you're going to see copper going nuts, gold going to go nuts, and silver is going to go nuts. Then yeah, then inflation, it's going to be a hell of a second wave. But if they don't, which is my base case view as I shared here already, yeah, I can see, more pain in markets, and which would be which could mean a little correction in metals as well. And would I think that that is a real correction in a beginning of a bear? No, it's just normal. We're going to see a little pullback as other things pull back a lot more, and then potentially an outstanding window of opportunity to be a buyer again.
Hmm. Now let's have a little focus on the stock market. You also comment quite frequently about that, especially the fact that we are in a bubble, and that there's different indicators, and you always share different metrics, different charts. What do you think describes best the stock market at the moment? Which charts are you looking at? Is it the Nasdaq, the S&P 500? How would you describe that at the moment?
I'm paying close attention to the Mag 7 because the Mag 7 has been the Magnificent Seven stocks, the large cap names have been where passive flows have inflated those valuations so much and have been such a big impact such a big impact on the performance of the S&P 500 and those more classic indices that people look at, and the fact that we've had such another if you look at year-to-date performance, you're starting to see two sectors that are showing very, big weaknesses: consumer discretionary and tech, which are probably the most important sectors anyways. It is funny to see everybody turn so bearish on energy just because Trump is coming in and we're going to be producing a bunch of oil, and all this focus on lowering oil prices. And guess what's performing the best year to date? Energy sector. So it's funny how the obvious is always obviously wrong. And so now you're in a position where tech is leading the downside. You look at even today, right? Markets are kind of mixed, but you look at semiconductor companies, which is kind of a leading indicator for tech specifically, and they're falling off a bad. So it's these are important signs, and maybe there's some real rotation already happening. And so yeah, I think the markets could see a lot more pain in here, and markets are really overvalued. I mean, it's crazy. I saw this financial advisor, supposedly on CNBC the other day talking about how mega caps have this, now it's a great opportunity because they have some great discounts. I'm like, what discounts are you talking about? Like, I mean, when you're at 60 times earnings, I guess, and you go to 55, I mean, I'm not, it's people that just have this missed history, really. And this is the issue with the market overall. It's just, the composition of people like that is a large percentage of market participants right now, and they speak with so much certainty and lack of understanding about risk. And I think we're entering an environment now where, especially the rates where they are, junk bonds, interest rates is starting to rise. Just think about it. Like, why? If you have, if you're lending money to a company and you have all these kind of stacks of ratings, and you go take the worst one, which is junk, is the reason why it's called junk, and you take that and you say, all right, well, how much am I being rewarded by lending money to them relative to how much I would get rewarded by lending to the government, which has got a limited printing press and all, we'll figure out, right? And it's 3 percentage points. One of the lowest levels in history. You're like, well, that's not right. I mean, if there's risk here, and things kind of take a pain because of rebalancing and all these things, should that be 6, maybe 9? Yeah, probably. And so that to me is just like, people have completely priced out risk and think that everything's fine, and the Fed will always come back and help you. And the Fed will eventually, but not because of a 10% correction. And so the mega cap is stocks, going back to your question, they're already in the bear market. And if you look at a bunch of these stocks, a lot of them are already below 200-day moving average. Famous phrase from Paul Tudor Jones, There's nothing good that happens under the 200-day moving average. So, yeah, we're just at the beginning of maybe a bigger sell off. And so it's interesting that people have so much conviction to come out on TV and say that these things have great discounts and are super cheap. And, it's just, I don't understand where they're coming from, to be honest. I mean, maybe if you're living in a world of the last 10 years, 15 years, and you just completely shut off your knowledge about the history of stock market and the history of valuations, then maybe you can justify why these things are cheap. But man, I mean, I don't want to be in that world. I mean, I've I'm a student of history. And I think you can do very well. I mean, I've done well being bearish, and markets have done very well, and I've done fine. Knock on wood. So, I'll continue to learn about history and avoid big risks, and really focus on what I think it's very asymmetric, and it's not the equity market in the US. I'll tell you that. So, in my opinion, so that would be my views.
So to resume, you wouldn't see a top of the S&P 500 this year. It already reached. It's only going downwards.
I'll be my best guess, and I think, again, it could be policy dependent. Freaking Trump comes back and says, we're going to print money, guys. We're back in party. Let's go spend more money, not less. Forget about Doge. Trump, you're done. Trump, no. Elon Musk, you're done. Go back to SpaceX. We're going to actually give you more money and all that. Then, yeah, I'll change my view, of course. Then markets are going to go to all-time highs. And I don't know where gold would be. Maybe double from here in a situation like that. So it's kind of like, yeah, I mean, I'm comfortable with what I have in the portfolio, and I'm comfortable having a bearish stance, but being open-minded that, this is policy driven as well. I mean, if we all know they can take two routes, right? They can take the pain route, or they can take the Banana Republic route. Which one is easier? It's the Banana Republic route. So yeah, you got to be open-minded that they can come back with a bazooka and say, screw all this plan of cutting government spending and all that. We're actually going to do more of it, not less. So, and by the way, I'm not flip-flopping. Like, I'm bearish. I have positioning that is bearish because I'm not seeing that tune right now, right? That conversation is completely opposite from that. It's like, we don't care that the market is down. We're, tariffs, immigration. We got to get these guys out of here. They're bad people, blah, blah, blah. And so, if that whole conversation changes, I'm allowed to change my views. And so, with that policy in place, with cutting government spending and all that, yeah, I'm very bearish. I think with the Fed being stubborn, I don't know how you don't see, a big haircut in the S&P.
Talking about the dollar, so the DXY index has dropped about, I think, maybe 5% from its 2022 peak of 114 to around 108 in March 2025. How do you see that dollar dominance developing in the coming years?
Well, look, the dollar has been losing its dominance in a big way, especially from central banks buying gold relative to treasuries. If you look at that chart, not that they haven't been buying treasuries, they have, but they've been very focused on buying gold. And the dollar is at a dangerous position in a certain way. And I believe it's inevitable that we are at a turning point in history, that the dollar could see a long-term decline of its valuation relative to other fiat currencies. Forget about hard assets for a minute. I mean, that's an obvious view that I've shared many times before. Obvious meaning something not that is obvious in the market, but it's obvious that I've already expressed that view in the past. But I think that one very underrated opinion in markets that is very unconventional is the fact that, maybe the euro could appreciate versus the dollar. Maybe the Brazilian real could appreciate versus the dollar. Maybe the Japanese yen looks better than the US dollar. Maybe the BOJ is in a better position to raise rates than the US to ever do that again. And so why? Because they got a bigger cost to service the debt than Japan. Even though Japan has a ton more debt, they kept rates so low that they're in a better position than the US. They're paying 0.9% of their GDP to serve the debt, while the US is paying 5%. So which one's in a bigger debacle to lower rates? I mean, it's pretty clear to me. So that reflects on the yen, and so I think the dollar is in a very important turning point in history, lower, not higher. We've seen two other times that the dollar was as overvalued as it is today. Those are major, major peaks. One was in the 1985 Plaza Accord. Plaza Accord was a coordinated act across central banks to reduce the value of the dollar. And at that time, we saw, basically an effort to lower the dollar. And at the same time, as capital, if you think about the world, capital was coming out of the dollars, getting into other currencies, inflates assets of those currencies. So we saw a bubble of the Japanese market that we've never seen before. Markets are just returning from those levels now in Japan. But that's how big of a bubble it was. And that's because money was coming out of the dollar and getting into this other market was really cheap until it got very expensive and then it peaked. But emerging markets did very well. And then 1930s was another period that the dollar was at its peak. And so you had, I'll give you an example. That was a time when we had 1931, Great Depression. The economy globally was at a very bad place. And some economies, the UK, Canada, Germany, Austria, I said Canada already, they all got together and basically said, well, look, not together. They all kind of act similarly, but not coordinated, and said, well, no, things are so bad that we need to devalue our currency versus gold. They broke their gold standard. And at that moment, imagine a bunch of countries breaking their gold standard, and then the dollar keeping its gold standard at that moment. In 1931. So, the dollar surges, dollar surges. Yes, gold surges too, but the dollar surges because all these other currencies lost, their discipline completely. So the dollar goes to its peak. For 2 years, it reaches its peak in 1933. Then the global economy is still stagnant, right? And nothing happening. Recession, the depression was still there. Market trying to bottom. So they do a whole, try to coordinate an act. And so bring all central banks to London, in presidents and so forth. And all right, well, let's come up with a plan. And can't find an agreement. Roosevelt leaves the whole thing mad. And this is a whole story at the time. And imagine, just like Trump, right? Leaving an international conference and saying, screw these guys. I can't come up with an agreement. We can't find common ground. Comes back to the US 1933, and guess what he does? He breaks the gold standard himself and devalues gold domestically, devalues the dollar domestically relative to gold. And that was the peak of the dollar, right? Because all these other currencies have already done that. So it was the moment where the dollar had to, lose its value. So it wasn't coordinated, it was organic. The US needed to do that. So now the question becomes, all right, we're in the position where, similar to 1985 and similar to 1933, where the dollar is at its peak. And I don't know if it's coordinated, if Trump finds a way to just talk to these guys and say, well, let's just devalue the dollar, helps us to fix your, current account situation and all sorts of things. And, or if it's just organic. There's something that Druck Miller talks a lot about, and Paul Tudor Jones. There's a combination of factors that is very bad for the dollar. That is austerity with lowering rates. That's just not good. The dollar does not like that. What the dollar likes is government spending aggressively, so growth, and at the same time tightening monetary conditions. You got a combination of those two, which is the opposite what we have today. The dollar surges. So, on that alone, you should be bearish on the dollar. Like, forget about everything I said. Just focusing on that, you should be bearish on the dollar. Then you look at interest rates and how much we're paying to service the debt, 5%. Everybody else is at 2 or 1 or 0. Who's got to cut rates? The US versus other countries. It's a relative game. That alone should give you reasons to be bearish the dollar. And then what's the third one? The US is in a position where maybe it can coordinate an act. Maybe it's the Mar-a-Lago Accord. I don't know. I mean, these are all discussions that could be occurring. And so maybe the US needs to buy gold. Why they will continue to see international central banks buying gold, and Treasury Secretary Scott Bessent, of which had his largest position on gold before taking his job, looking at the situation and just sitting out and saying, yeah, let those guys buy gold. We'll just do our own thing. No, he's not going to do that. We all know that. Probably going to find a way to buy gold. And so buy gold, that means lowering the dollar. And so I just don't understand how other people maybe are not seeing this very clear trend of 5 to 10 years that the dollar needs to be devalued quite significantly. So I'm really focused on this because it's probably the most important macro trend of the next 5 to 10 years.
Clear, very clear.
Sorry to go long.
No, but it's perfect. It's perfect. Going to the bottom of your thought. So now let's keep this in mind. And you've just mentioned it as well with the role of gold, but also commodities, especially at the beginning of the conversation. And I would like to entertain the thought of the commodity supercycle, which according to all what you said, we have a lot of those factors that come into play. We've seen a Bloomberg commodity index that has risen, I think, about 15% since 2014. We've also seen that in the early stages of the 2000s, we had a similar setup where in the 6 years developing up to it, it went up to 150% up until like mid 2000s. Would you say that with like the current shrinkage of supply, the capex shrinking, like all those problems, we might have the perfect storm for a hyper or super cycle in the commodities in the next 10 years?
I really think that that's the case. I mean, I think that if you're not looking at commodities and taking an approach of really focus on, a niche strategy among natural resources, I think that I just see this as one of the most best opportunities out there. And commodities and emerging markets, they tend to be impacted negatively by two things: rising interest rates in the U.S. Because it creates competition. People wants to buy treasuries, and also like, why would you buy a Brazilian bank, with so much risk when you can buy 4%, or treasuries with 4% yield or something along those lines, right? So think about that. That's a clear, winner. People are gonna go for the treasury market. And then on the top of it, the other thing that is very negative for commodities in emerging markets is the dollar, strength of the dollar. Like, you got a dollar strengthening and so forth. Who wants to sell dollars and put money into Brazilian bank again, just to pick on that and be positioned that way? I mean, nobody's with the logical path of thinking about capital deployment would take that direction. And so, however, in the next 5 to 10 years, you probably have the opposite of those two, right? You have an effort to lower rates and an effort to lower the dollar. So you taking the biggest risks to invest in those things out of the equation. basically, or at least substantially lower as a factor that matters than other things. So yeah, I can't help but be, you know, very bullish in those markets because I think that they, as we see rates in the 2 year being cut in half or so, and as we see markets, sort of continue to rebalance to other places, I would suspect that those markets will do very well. I also find it interesting how things have been changing more in the last few months, where when the markets fall, equity markets in the U.S., you are also seeing the dollar selling off, right? And this is very different than 2008. Oh, 2008, you know, so many famous and popular phrases about you want to flock into the dollar, and the market falls, you buy dollar, you buy dollar. Well, do you? I mean, is that what you want to do? Or you're in that 2000 tech bubble environment where you actually buy gold, you know? And I am of that view. I just think that, yeah, things can fall, emerging markets can have issues, and miners can have issues when equity markets in the US, really sell off. But and you think of the relative performance of those markets versus the US is going to be very different. I think there are going to be great ways to invest in those parts, those segments of financial markets that could be big beneficiaries of a lower dollar and lower yields overall. So it's a exciting time for those who've been following those markets for a long time. And I can't help but focus on energy, metals and mining, South America, places that I think are wonderful opportunities to deploy capital into.
In the commodity market, there's quite a lot of, let's say, assets that we can look at. And I think there's also one that you had talked about also very recently, that is copper. What do you like? What interplay do you see between the shrinking supply? I think like the 20% drop that we've seen in copper since 2015, it was quite significant. And the rising demand from what you also mentioned with the electrification and infrastructure development in the world. How do you see those two?
Yeah, I mean, this AI arms race is important because it's definitely um, creating a situation where electricity consumption could be drastically higher. And on top of it, now you have real efforts to onshore. I think that's a real trend. Don't underestimate that. Trying to build factories in the US, trying to bring companies back to the US for tax purposes, all sorts of things to change, the world in that direction. And it's not just the US, actually. I mean, it's Europe, it's onshoring is happening in Europe, it's happening in Japan, it's happening in Canada. And I think that you're going to see a surge in electricity consumption in the US in a big way. And I believe that copper will benefit tremendously from that, but also from construction overall. I mean, think about what is one of the biggest issues the US economy faces today: inequality. Inequality, which is exacerbated by housing affordability. Housing affordability is exacerbated by the fact that there's no inventories. So, how do you fix that? You build, you have to. And so how's that negative for copper? How's that negative for any metal? So it's going to be, we're going to see some very important changes in that front as well. Of, the home builders are going to be in a very positive environment, in my view, for the next 5 to 10 years. We may see, markets decline, and those things can actually have issues. I'll be a buyer of those stocks if that's the case, because I think that they're going to be in a very good place moving forward. And so, to answer your question, yeah, I mean, copper falls into all these big trends. And And plus the fact that gold is rising substantially, and copper and gold follow each other like crazy as well. And it's hard to believe that if you're calling for gold to be substantially higher in prices, that copper will be, diverging from that. And so I think that we're going to see some continuations of big trends, um, of copper doing very well in the next 5 to 10 years. It's a focus of mine as well. I mean, I've been trying to acquire some very significant copper gold mines, and you know, no, it's one of the things I feel very very excited about. I mean, and a lot of other metals will come and go. Copper will always be one of the most critical ones that you need um, to rebuild uh, the economy. And we're in the process of seeing a rebuilding of most G7 economies right now.
In this context of the commodity boom, how much do you actually think that it is tied to the bust or like the distrust actually in fiat currencies versus the industrial needs? And if we look at commodities like gold, copper, but also oil, we haven't talked about oil. What do you think? Which asset has the biggest, most explosive upside from here?
I think it's a mix of factors that are causing commodities to do very well. It's not just industrial spending and efforts towards that, but also if you just look alone on the capex front, most of the producers have been in a depression on spending, which that alone should give you a reason to be more bullish in that space, because um, that tends to mark major bottoms in natural resources. So, it's kind of like, yeah, you're right. It's like the perfect storm um, for all this. But at the same time, if you look at globally, leverage, debt, we're at a peak level. And how do we get out of that? Let's go back to that topic. There's two ways. You take the pain and you don't grow, or you inflate your way out. Which one do you think it's politically easier to do? It's inflating your way out. So, you know, then it's hard to believe that in that place we're not going to see hard assets becoming increasingly relevant. You look at positioning, most hedge funds, most family offices, most central banks have a lack of hard assets in their books. So, that's probably going to drive quite significantly those assets to do very well. So I'm very yeah, I think it's all sort of a big part of all this. And then lastly, the supply side of it that you're asking, the quality of supply is deteriorating significantly, right? I mean, it's quality. Then you have lack of new supply coming online. You have lack of also, new developments of resources, no exploration. So there's no new supply coming in. So, this is sort of, I don't know how that, ends with commodity prices lower. I think it ends with commodity prices a lot higher. And your last question was, what do I think about which commodity is the most asymmetric? Well, I could give you the sexy answer and maybe a unique answer. The sexy answer is silver. Obviously, I mean, silver is the supply side is extremely tight. We know that it's been got demand factor changes happening under the surface, so particularly coming from solar panels. But it's also a monetary metal. People forget about that. But when gold goes up as much as it has been, most likely it's going to be seen as a monetary metal too. So, yeah, it's extremely bullish for silver at what we're seeing, and it wouldn't shock me to see crazy levels in the metal. And I'm going to just say one other metal that I'm extremely bullish on that I think is extremely asymmetric. It's zinc. Zinc is something people have been very bearish on, and it's something that is used in any construction and any type of expansion. So if you're betting on, inflating our way out. Is there anything better than something like zinc? It's hard to find that. And by the way, there has been very small amount of new discoveries of zinc, we are very focused on acquiring silver, zinc assets, and we think it's, if you look at the prices of the metal throughout history have been in a kind of upward channel, and it's at the very bottom of that channel right now, which even from a technical standpoint, you should be all in. But yeah, it's really interesting, and I think it's going to become part of the news at some point.
We've seen, and obviously we talked about Iran a bit, and you've mentioned a few times gold. We've seen all-time high after all-time high. We've been today actually hitting a new all-time high above the $3,000 an ounce, and it just keeps on coming and coming and coming, yet there's barely any headlines about it. It's still basically put on silent mode. Why do you think is that? And what is the bigger play in the background?
Bigger play is on mining. We're in the age of mining right now, golden age of mining, because gold is now approaching 3,100. For you to mine today, you're spending really less than $1,500 on an ounce to produce, and so you're talking your margin is at least 1,600, double your cost, and it's insane. I mean, these companies are going to print cash flow, and markets are completely dismissing that improvement on fundamentals because they worry that these guys are capital destroyers, and they are, but they also have been in such a period of low liquidity, low volume, and neglection that they are in need to make changes. And so they're very likely to be much more disciplinary with capital, and they have been. And that's going to translate into incredible profits. And so I think we are owners of the fourth largest, now it's the fourth largest silver mine in the world. And we bought that as a leverage buyout when silver was at $17. I like to tell this story because it's so important, because when I was looking into buying this, I would be talking in conferences and places, and not about the deal, but about silver. And people were like, well, I do think silver has a little more downside before it bottoms and all that. Some people saying it would go to $15. And I'm like, guys, like, what an irrelevant conversation. Like, who cares if from 17 falls to 15 when you have this massive upside? Like, what if you're wrong? You miss a great opportunity because you're just putting all your hubris on trying to perfectly bottom this, find the perfect bottom for this. And it's like, nobody can do that. Why would you even try? Like, buy a 17 and hold it. And if it falls to 15, buy more, or just be quiet and wait until things go up again. And it's like, I don't know. I see so much. Like, that was, to me, it was a lesson, not on a mistake. It was a lesson on a success that I think it's one of the most important lessons I've had in the recent years, which is to not be too cute on your investment ideas. Okay. Come up with an idea long term. Is that the dollar falling? Is that yields falling? Is that the gold price is going higher? Is that buying miners? Don't be too cute. If the asset you're looking at is at 35 and you think the potential is for $150, $200, $300, why do you care if it falls to 25? To 25, that's a big drop, right? It looks like a big drop. It does not matter. At the end of the day, it's buy with both fists and go for it, my opinion. So this is the way, we did it. We bought this mine. It was trading at one time free cash flow, and now it's like just this wonderful investment. And what if I would have listened to all these experts, of which a lot of people see me as one of these guys, and I'm like, no, I'm definitely not trying to be in that camp of calling every dollar change in silver and others. I mean, I couldn't care less. I mean, I'm focused on the big picture. I'm not here for the 40. I'm here for a lot more. And I'm also not here to be quoted on things on that front. I'm here because I think this thing is extremely undervalued and it's probably going to have a huge run. And if you can find mining companies that are successful at mining and have an edge on those margins, oh man, it's going to be interesting. I look at the gold to oil ratio right now. It's second largest level in history, and that is a pure reflection of margins in the mining space. And so, extremely exciting times if you're in the mining industry, in my view.
Now talking about gold, I wonder what your takes are on this. We see a very large move from gold reserves going more and more eastwards, and it kind of always kind of hints at something: follow the money, follow the power, follow the gold, follow the power as well. This resurgence of gold purchases, especially for central banks in the East, kind of shows a bit of a change in the game as well. And some people also wonder, would that also mean that if we look at the gold exchanges, the ones that actually price gold, could they maybe move eastwards? And if they do, how would Shanghai, Russia, and Dubai could set the price of gold? What's your perspective on that?
I mean, it's an important question. I think those discussions usually underestimate the knowledge of U.S. policymakers about gold, especially these new guys that are the new guys in town. And I think that they are very much aware of what you just said, and very much aware that they are been opting out of this buying spree on gold. You know, international central banks own about 50-year highs on gold reserves, and the U.S. is at 90-year lows, 90. That's insane. So, you know, when you see things like imports of U.S. of gold from Switzerland, you know, I don't know if it's the U.S. government buying. What if it is? You know, what if it is? You have to be open-minded because they're not stupid. And I think there's a big push towards, you know, replenishing gold reserves in the U.S. They talk about revaluing gold. Why would they revalue gold? Let's think about that for a minute. Because it would make gold prices a lot more expensive for those countries you mentioned to accumulate. Makes a ton of sense. Unless you think you have less gold than those other guys, which might be the case. So then what do? So then now you have to become part of the buying spree, right? And you got to get out of your 90-year low and start buying gold. And guess what? The news and most of investors, especially young guys that dismiss gold because it's just, you know, it doesn't matter. It's too old and only old people look at gold and it's not something that's going to make you rich. They're right about that and very unlikely to make you rich buying gold anyways. But the derivatives of gold can do very well, right? That's the key aspect. So everyone is focused on this other stuff, which is Bitcoin reserves and all stuff. Look, if you're serious about buying something and you are at a volume that if you start buying something, you move the market, you don't announce to the world you're going to do that, right? Like that would be the dumbest decision. It would be the US coming out tomorrow and saying, hey, I hope they don't do that. Hey guys, we're going to be buying gold for the next 5 years. We want to exactly the same tagline from Bitcoin. We're going to do, you know, the equivalent to 1 million Bitcoins. We're going to do, I don't know, you know, how many ounces of gold that we want to own just to, and we want to reach that in the next 5 years. Holy cow, what do you think it's going to do to gold? You know, gold is probably going to go crazy. And now you can't buy what you said you would buy because it's going to cost you a lot more. You can't do that. So then what do? You hiddenly buy something and then you announce to the world, and by the way, I just bought this much gold, you know, and we're committed to this. And, you know, then, yeah, then that's a winner strategy. I suspect these guys are doing that. And, you know, I really do. And
Okay, so that's an interesting thesis, hypothesis, is that they're basically announcing kind of this honeypot thing of, hey, we're going to actually sell gold to buy Bitcoin, prop up Bitcoin for that, but actually doing the reverse.
And look, if I'm wrong, I'm Brazilian. I own all their stuff in Brazil, and I don't care. And that maybe might be the end of the dollar reserve currency. Okay, if I'm wrong on this, it's a serious threat. I don't think these guys are that dumb. Like, I really think Scott Besson knows very well the role of gold. I think it takes extreme situations to bring those guys into leadership roles. And, the fact that we have dismissed gold for so long as a government, yeah, I do think that there's a very high probability, let's put it that way. There's a very high probability that these guys have a very serious strategy to accumulate gold moving forward. And maybe revaluing is not the right strategy because they are not confident that they own enough gold versus those other countries.
And that's also kind of the topic, and we discussed, for example, with Matthew Piepenburg, and also Goldman Sachs mentioned that China might have 10 times the actual reserves that they portray to have.
But if they do, it's small, right? Still relative to the US. Let's just say they do. It's still not big. It's significant, but it's not what a lot of people think it is. And so it doesn't mean they're winning either. I mean, I think they're doing the right strategy, and they're doing the right, they've made the decision much earlier than the US, and that's very good. But it also doesn't mean that that we're going to see the yuan becoming the reserve currency because China owns a bunch of gold. I really don't think that's the case either. I think there's extrapolation of that view as well. But I don't know, it's my 2 cents. I don't know.
Well, I mean, if China has like 2.2 thousand tons of gold, 10 times that is 22. USA has 9. Yeah, well, it's pretty significant.
It's significant, but I think the US also has major deposits of gold here and things that are, we're not seeking as reserves, but if the US wants to get involved in those things in a serious way, which, by the way, it's a huge tailwind for miners, is the fact that the US government may actually be one way to accumulate gold. I mean, I've had discussions with a few guys that are in the White House in a big way. And I asked that question. I'm like, yeah, you can buy gold, and that's the obvious, sort of direction you can take, like China's been doing. But what if you develop your gold deposits you have here, which you do have a lot? People look at China, oh, it's a large producer of gold. Oh, the US is just opting out of that. I mean, they could become if they wanted to, and they have enough resources here. So why not do it? And maybe it's a cost question, but if the government is serious about accumulating gold, that can be an option. And I don't think people are really seeing that as a potential, actually. And it could become an option very quickly. This would flow capital into mining. Oh man, it would change a lot of things here. So yeah, it's interesting. By no means I'm dismissing how much China could have in gold. I think that's very relevant, very positive for gold, good for China in that standpoint. But does it? I'm not sure it changes the dynamic that much. I mean, I think what changes is that revaluing gold may not be the best option. It may be. What if the US owns more than what they have reported as well? No. Why people are not saying that? Like, it could be the case. They could be accumulating, like I said. Like, what if this whole imports that we saw from, it was really the government actually buying gold? I mean, there is a very high potential that could be the case, and people are just dismissing that, talking about Fort Knox and all these things, and maybe we do have more. I don't know. I mean, really, think that nobody knows these questions, but the point is that $3,000 gold, and you have international banks buying as much as they have been, and the U.S. being pressured to do the same, does not probably translate into lower gold prices. It probably translates into a lot of higher prices in gold. So we might be in the very beginning of a secular bull market for this.
To push back on the mining part, though, if I look at the numbers in the US, it's about 170, right, in terms of tons of mining per year.
Are you talking about what? Sorry,
production, just mining, just gold.
Sure.
Yeah, and China is around 330. So China would still have like a major comparative advantage, and Russia also has 320 or something.
You're talking about developed things versus things that have been developed already. They're producing now, correct?
Yeah.
Just to make sure. Yeah. What I'm saying is, if you put things into production that you don't have into production, and you actually develop those things, which there's major deposits of gold in the U.S. underdeveloped that could be putting into production, and that can change the production size by a multiple of what we're seeing now. Where maybe China might not be in that position. So,
but that will take years, right? I mean, to set up a mine, or like 5 to 10 years now to just to get operating or not.
I don't. I mean, but it doesn't matter, right? I mean, if they have the gold, they have the gold. I mean, it's a matter of taking it out. What I think it's the importance of what I'm saying that is not in markets right now is this intervention of the government into mining that we haven't seen in many years, in maybe centuries even. The U.S. government getting involved in mining gold for its own reserves. I can see that.
And also the whole resource game with Greenland as well, Canada. That's not just for nothing. There is a real agenda behind this, and it's resources.
100%.
We haven't talked about this at all, actually.
Yeah, 100%. 100%. I mean, resources. And by the way, this is why I'm so bullish in South America, is because it's a very unexplored area. People know about it. People in the top administration, and we could see some important. I mean, look, the U.S. could finance a lot of things in exchange for gold. Why not? I'll help these guys to get something into production, and in exchange for some gold or something along those lines. Like, that could be things that we're not thinking about that could become one way to actually accumulate gold, rather than being in the market bidding on gold prices going a lot higher, right?
Mm-hmm.
I mean, that's a very valid strategy to accomplish accumulation of gold. I'm trying to think outside of the box. Like, there's the obvious play, right? When you print money and buy gold. Sure, you can do that. As soon as the market learns that you're doing that, and it's oh my gosh, your currencies goes to the toilet, right? Because you're devaluing your currency versus gold essentially, and inflation, all these things. But what if your policy now is just to mine more gold and own it? Could be an interesting way.
Yeah, it all comes together, and also the deal with Ukraine about minerals. It's all, I think, part of a bigger plan to make also the US more, resource independent, but also resilient, just in case this big East versus West type of war, in whatever shape and form it might take, that they are secured on that sense.
Yeah, I mean, and some of these stuff. I mean, unless, I think the Canada stuff is real in terms of the push for resources and all that. Sure, I agree 100%. Greenland and Ukraine, I don't know. I mean, I've worked with a geologist, Quinton Henny, very closely. He doesn't think there's much in Greenland. The whole rare earth stuff, and maybe, but it's not real where the big prize is on that one. So I think Ukraine has maybe a little more stuff outside of even rare earth that might be interesting. What we should be really doing is not doing rare earth investments, is actually investing in refining and smelter capacity for those things, because we have access of those things. We don't have access to the refining capabilities that China, has way more than any other country in that front. So that's a scary part of it that I think it's extremely relevant. Yeah.
So the refinery mean also like the whole infrastructure, like the whole capex we've just mentioned. So that's really a big bullish call. How do you even choose those stocks? How do you go about it?
Oh, I don't think there's real big ways. I've been thinking a lot about this actually, how to invest in refining capacity of metals in the US. I don't know. I've been thinking a lot. I've been putting a lot of thoughts in this. Being very honest, I don't know what's the best way to play it, because it's also brings pollution, right? There's, and so, but the U.S. is very open to this and so forth, and obviously, if you bring capacity of refining in the U.S., it's gonna have polluting, impacts that we need to consider. So, do they actually create a relationship with other emerging markets? Like South America, to have them polluting their own countries in exchange for, I don't know, I think they're going to have to think about this. I mean, that's what they did with China, right? Until they realize, oh, holy crap, we actually don't have any refining capacity now because everything is in China. So China's polluting, the crap out of their country, but they actually have capacity for all these things. So, it's kind of like, we went too far from one side now, and now we're trying to bring it back. And these things are expensive. It takes, a couple $1 billion to build one, and it takes years to build. And it's not even about permits. Let's just say the U.S. just clears up all the permits. We need it. It's essential. It still takes a few years to get it. So we're still screwed on that front. So, yeah, I kind of think that's a very relevant. But maybe Greenland, right? Maybe you acquire Greenland and do that. Maybe that's what you're trying to accomplish. You need land. So I don't know.
Greenland.
I'm coming up with ideas here in on spot, but it's, I think these are real options that need to be considered because, this is a real threat for the U.S. economy.
Yeah, Greenland wouldn't be that green anymore, I guess.
Not at all. That front, would be very bad. Yeah.
Greyland. All right, Tavi, thanks a lot. I think we've really overreached almost the precious time that you have. Appreciate your insights. You are basically available on X for all kinds of analysis that you share. Is there any other things that you would like to share to the viewers?
No, not. I mean, I think I share my views hopefully well, and as you can see, there's a lot of we're on the cusp of a lot of opportunities, and I for those who've missed the gold movement, I think the derivatives of gold are still great opportunities that people are dismissing still, and there's a whole range of things that you could be doing to take advantage of what I think is likely to happen, which is the catch up of all these things. As the mining companies, other metals, emerging markets, all sorts of things that are linked to gold prices in a big way, and could be very interesting. But thanks again for the interview. Look forward to speaking again, and appreciate the opportunity.
Yes. Very welcome, and I appreciate your time. And I think that's actually maybe a good topic for next interview and follow up, to dive more into exactly those kind of topics, to see how to catch a train and still do the most out of your investment by buying these derivatives. And I've also heard that you don't even own gold; you only own actually miners and all kinds of exposure to gold. So it's also interesting.
But they're not your gold physical bars that people talk about. No, almost zero. So you can come to my house and try to put a gun in my head. You're really going to have to talk to my broker. I really don't have anything in my house outside of some whiskey, some nice wine, and that's about it. So
some cigars. You smoke cigars as well?
I don't smoke cigars.
No, you don't smoke cigars.
But
I heard whiskey. I thought maybe cigars might be in the mix as well.
No, I'm just joking around. Now with the kid, should probably get rid of all this. So, but anyways. Fun stuff.
All right. Muito obrigado. Thanks a lot, Tavi, and I hope to talk to you very soon again.
Muito obrigado. Take care.